or an object, or for that matter a firm. So when we're talking about business establishment or an organization which is manufacturing or trading or involved in banking activities, then what do we mean by the environment? When we talk about this environment, we're basically talking about what are the factors that are affecting the performance of the farm, or the path that the farm wants to follow, because every farm has a desired objective. It works with a certain objective. Now, what are the factors which are contributing towards achieving that objective, or what are the factors that are hampering going towards that particular objective? All these things are collectively called as the environment of an organization. Now, obviously, and some people refer to this environment as internal environment and external environment. But essentially, when we talk about an environment is essentially external to an individual or an organization. So because it is an external object or external thing outside of the organization, we obviously have no control over the components of the environment. So basically, I cannot expect certain things to behave in a certain way because I'm operating in a particular environment. So what the organization which is operating in an environment then will be forced to adjust its strategies, and it has to tailor its own policies and its own internal practices, so that it can cope up with the changes that are taking place around it in the environment. So unless you cope up with these changes, it will be very difficult for the organization to achieve the desired objectives. Now, what kind of changes can we speak about when we talk about the environment? The changes could be relating to economic. For example, there is a change in the tax system, or there is a change in the interest rate. So these are all economic perspective. There could be a legal perspective. The changes in the legal system. Suppose tomorrow the government of India says that, well, for it is the age of employment in private sector has been increased to minimum for 25 years. So that will mean a lot of our manpower will go redundant. So because it's a directive by government of India, then it is a legal directive we have to obey. Then again, we have social changes, we have cultural changes, we have also many ideological aspects. So because of these kind of changes, we see that the many companies are forced to undertake various activities in the name of CSR, the corporate social responsibility, because we have to project that we are also adhering to these things. So when we talk about an environment, we talk about all these aspects: the economic aspect, the legal aspect, the social aspect, the cultural aspect, as well as the ideological aspect. So how does this operating environment has an impact on the working capital? Now, when we talk about the working capital decision, yesterday the last class we saw that the inflation, which is a part of the environment, has a great impact on the working capital management of a farm. So when we talk about working capital decisions, then which components of the environment that are important? So when we talk about the components in an environment which are important for working capital management, basically I'm talking about the economic aspects of the environment. I'm not touching upon the legal or cultural or ideological aspects. I'm only talking about the economic factors in an environment that affect the working capital management. Now, in economic factors, we can talk about the monetary and credit policy, which is predominantly decided by the central bank. Then the changes in the inflation. I think yesterday in the last class we did a deep discussion on this inflation. And we can also talk about the various changes that are happening in the financial market. All these changes have go a long way, these changes, and they contribute to a great extent to how efficiently an organization can manage working capital. So we'll see each one of them point by point. So we'll talk about the monetary and the credit policy first. Now, when we talk about the monetary policy, so what is the policy basically is monetary policy is a tool that is basically used by the central bank, the Reserve Bank of India. So it's why is a monetary policy important? Because monetary policy is employed to control the money supply, and in effect that has a deep impact on the economic growth of a company. So we can say the survival of a country, or the growth of a country, or the general scenario, industrial scenario of a country are very much affected by the money supply and the economic growth of a country. So Reserve Bank of India Act 1934 has mandated the central bank to issue these kind of monetary policies, which there is a minimum every quarter you come up with a new monetary policy. So in a year you can minimum see 4 announcements regarding the monetary policy. So what does the central bank try to do with this announcement of monetary policy? They talk about they regulate the issue of the banknotes, keeping reserves. And why to keep reserves? Because in scenarios of monetary instability, then the reserves could be used to make the scenario stable. And how the currency and the credit system in the country will generally operate, that also is decided through this monetary policy. So the monetary policy is a tool in the hands of the central government and the central bank to regulate the economic environment of the country. So obviously, when we talk about a manufacturing firm or any other kind of an organization which is operating in this kind of a economy, the monetary policy is bound to affect the working capital, because we see the monetary policies are the short-term policies. These are announced every quarter. So these are short-term policies regulating the money supply and regulating the economic growth. So this monetary policy will have a very, very direct bearing on the working capital management of organizations. So we'll see which aspects of this monetary policy is important. Now we'll talk about several factors like money supply, bank rate and all. So we'll pick up each one of them and talk about how the money supply and all affects the working capital management. Now, when we talk about money supply, so what do we basically mean by supply? It talks about, when somebody is talking about money supply, it is basically the quantity of monetary assets that are circulating in an economy at any given point of time. That is known as the money supply. Now, why I said the monetary assets, I didn't use the term currency notes or coins. I use the term monetary assets because monetary assets includes the currency notes and coins. Apart from that, there are several other factors also which are a part of the monetary assets. Now we'll see what are the monetary assets. You have this monetary asset is a very crucial indicator as it affects the inflation, the interest rate and overall economic, because the money supply plays a balancing role when to control the inflation and the interest rate and the overall economic activity. It is the role of a balancer. Now, money supply is typically, we can talk about a narrow money and a broad money. Now, when we talk about a narrow money, we call it a M1, and the broad money, we use the term M3. So what is this M1 or the narrow money? Narrow money talks about the currency in circulation. This is the notes that we are talking about, the currency in circulation and the demand deposits. Now, when we talk about the M2, then the next level of monetary items are M2, which includes all the assets of M1, plus we have savings deposits that we do in the banks. We have the time deposits. We have the money market mutual funds also available in the money market segment. Then we talk about the broad money. When we refer to it as the M3, the common usage for the term broad money is M3, which includes all the items of M2, plus you have large time deposits, you have institutional money, you have market funds and other very liquid assets are a part of the M3. So when I'm talking about money supply, I'm basically referring to the M3 part. In terms of working capital management, I'm basically referring to the M3 part. Now, why is the money supply is very important with this thing? Now, the objective of this monetary policy in India has been that the money supply has to maintain the real growth and the containment of inflation through this expansion of M3. Now, this expansion of the output expansion happens when money is available freely, when the broad money is available freely, then the organizations which require working capital fund will be able to access the money and use it for their productive purposes. So when money is freely available, suppose I need a loan and I am not able to get the loan, then my business activities will be hampered. But when I require the loan and the money is quickly available to me, I'll put my operational plan into make the operational plan active. So and that will lead to the operating cycle being faster and produce more amount of profits and productivity. So what will happen is with proper availability of this the expansion of M3, the output will expand, the productivity will go up and the output will expand. Now, in India, output expansion and price stability, they go hand in hand. But the central bank has always focused more on the price stability part, because if the prices are not stable, the real growth will be in jeopardy, because as we know, if the prices go up, that is the inflation shoots up, then there is no real growth. Suppose I am growing at a rate of 7%, whereas the is going at a rate of 9%, then the real growth is actually negative. So on the one hand, we have to look at the output expansion, that the productivity is increasing, but at the same time, we have to keep an eye on the price, whether they're stable or not. Because if prices are not stable, then the real growth will come to jeopardy. So in that sense, the M3 plays a big role. Now, how has the monetary policy in India, it has evolved over a period of time. So the initially, to start with, the expansion of the credit and introduction of measures to smoothen the flow of credit to every needy sector. So the monetary policy initially focused on how every sector of the economy will get sufficient supply of money towards the availability of the credit. Then the policy of multiple indicator approach was introduced, wherein we placed more emphasis on the interest rates towards availability of money than on the factors that cause the variations in the money supply. So we used interest rate as a controlling tool of the money supply. Then the short-term interest rates were given more focus. So because earlier the long-term interest and the long-term loans were given more focus, and the long-term interest rate was always given more priority. But with the development over a period of time with liberalization, the short-term interest rate has been given more focus, and it has emerged as a very key instrument in the monetary supply. Now, the main development in the monetary supply is the constitution of the Monetary Policy Committee, MPC. Through an amendment has to be, of course, had to be made to RBI Act to accommodate the MPC. So this MPC brings about more transparency and accountability to the monetary policy of the central bank. Now, what has been the impact through all these changes that have been affected in the monetary policy? What has been the impact on the actual supply of money? Now, these changes that we talked about, the amendment of RBI and all that, and the constitution of MPC, it is evident that the vital statistics supplying to the pertaining to the money supply, credit, and the foreign exchange reserves, they have been deeply impacted. And this data, I'm referring to the RBI's bulletin. So from this RBI website only, this data has been collected. So the broad money, that is M3, which stood around some 202 lakh crore, around 202 lakh crore, registered an increase of 7.6% over its previous year. So the bank credit, net bank credit to government has also been increased by 2022 by a 8.4% in the as compared to the previous year. Whereas the net bank credit to commercial sector also stood around a hefty 124 lakh crore by the end of financial year of March 22. So this increase has also been around 6.5%. So what I'm trying to tell you here is that the money supply, the monetary policy has ensured smooth flow of money not only to the government sector and but also to the commercial sector. Otherwise, there would be crowding out of this investment. So it has ensured both the government sector as well as the private sector having access to the proper access to the money supply. Now, the second tool that is being used by the central bank for controlling the economic environment, that is the bank rate. Now, the bank rate is it is a rate that the central bank charges to lend funds to the commercial banks. Now, the bank rate obviously because it is the rate at which the commercial banks are borrowing from the central bank. Now it will serve as a basic rate or the trade benchmark rate, which will influence of course the lending rates of commercial banks. It will obviously charge higher than the bank rate. The higher bank rate will translate to obviously higher lending rates and vice versa. Because ultimately the commercial bank, suppose the bank rate now stands at 5%, so the lending rate by commercial banks to the public will be obviously above 5%. Now, if the bank rate reduces, the benefit of this reduced bank rate will transfer to the customers, to the end users. Now, to curb liquidity, the central bank resorts to raising the bank rate and vice versa. So what happens is, suppose when we know that the central bank tries to control the inflation to this root of this bank rate. Now, if you increase the bank rate, now what will happen is the commercial banks will lend at a very, very high rate. And obviously, they will also give a higher rate on the deposits. So what will happen? The liquidity will be sucked out from the market. And if you reduce the bank rate, the central bank reduces the bank rate, the liquidity will be infused into the economy. So when more of money is available, the productivity cycle goes up, the consumption goes up, and probably affects the inflation. If you suck out the liquidity from the market, then obviously the people will start investing, saving more, and the productivity, you can control the inflation through that. Now, the bank rate, apart from controlling the inflation, has also a very psychological value as a tool of credit control, because the firms have keep a eye on the bank rate. Beyond a certain point of time, organizations feel that the bank rate is too high. So it has also a psychological value in that sense. And the bank rate has been used in conjunction with other instrument. Bank rate is not the only tool how the credit has been controlled by the central bank. It has also, bank rate is one of the foremost tools. It also uses other tools to effectively control this credit available to the various firms. Now, the more popular terms as compared to the bank rate, it is a common day usage, that is CRR and SLR. We all know that the CRR and SLR are the terms that we use in terms of, in case of commercial banking activities. Now, the this variation of this CRR and SLR is a very important credit control technique that is used by our central banks. Now, by changing this CRR and SLR, the bank can affect the credit creating capacity of the commercial banks. Now, we'll first see the concept of the CRR and the SLR. Now, under Section 42 1 of the RBI Act, the scheduled commercial banks, they're mandated to maintain a minimum cash reserve on the demand and time liabilities with the central bank. Now, the reserve, which was very high during 1990s at 15%, has been gradually reduced to 4.5% in the recent time. So obviously, if you are required to maintain a huge amount of reserve with the central bank, your credit creation capacity comes down. Now, with the reduction in the CRR, obviously the commercial banks are now able to give more amount of credit to the consumers. Now, similarly, when we talk about the SLR, the cash reserve ratio is the CRR, and the SLR, that is a statutory liquidity ratio. This has been talked about in the Section 24(2)(a) of the RBI Act. Now, the banks are required, it is mandatory for the banks to maintain a minimum amount of liquid assets. But and why is it needed? Because then you have to every day there will be liquidation of deposits and all that. So the bank has to be prepared for that. To maintain that, the central bank has mandated that a minimum of earlier it was 25% of your total demand and time liabilities had to be kept in liquid form. So we all know that if it is in liquid form, the return generated on these assets will be very, very low. So it will be less productive. Earlier in 1990s, this used to be very high at 25%. Obviously, with the reforms and the expansion of these activities, the SLR has been reduced to now 18% in 2024. Now, talk about the SCR and the SLR. Now, the bank, they borrow money from the other, you can see a table where I'm showing you the key rates applicable to the banking system. The key rates like the bank rate, the repo rate and the reverse repo rate, CRR, the SLR, and something called a marginal standing facility also available in the table. Now we see that the bank rate, which is the rate that the RBI charges the commercial banks. So the bank rate, which was at its highest around 9%, has been reduced, gradually reduced to 4%, 4.5% to the recent time. The repo rate is the rate at which the bank borrows money from RBI, but for a short duration. The bank rate is for a long duration, whereas the repo rate is for a short duration. So they lend money to RBI, and the opposite is the reverse repo rate. The repo rate is the rate at which the banks borrow money from RBI, and reverse repo rate is the other hand, where the banks lend money to RBI, or they park their money with the RBI for a very short period of time, usually overnight. So bank rate is a long duration, repo and reverse repo are for a very short duration. Now we see even the repo rates have been gradually reduced and is hovering around a 4% mark right now. The reverse repo rate has also been quite reduced. So both there is repo rate, reverse repo rate, bank rate, they have been used as mechanism to control this inflation. And reverse repo rate has been used to control manage the money flow. Now, repo, obviously the repo rate injects liquidity into the market. That is the rate at which the RBI is the bank are borrowing, RBI is lending to the commercial banks, has a deep impact on the liquidity of the market. So the repo rate, through repo rate, we can inject liquidity into the market, or you can suck out liquidity from the market, depending on the requirement of the central bank. The reverse repo rate, on the other hand, absorbs the liquidity from the market. So you employ, if you want to suck out the liquidity from the market, employ reverse repo. If you want to infuse liquidity, then obviously you talk about the repo rate. Now, and we talked about this CRR and SLR also. Now, what is this MSF? That is the marginal standing facility. The marginal standing facility, this is a window that has been created for a special purpose. When the banks need to borrow from the Reserve Bank of India, and when that happens, when this repo, reverse repo, they fail, in a very, very emergency scenario, when the interbank liquidity completely dries up, when there is absolutely no liquidity, then the MSF serves as a window for, it has been created by RBI. The commercial banks can pledge the government securities and they can get the liquidity facility from the central bank only when there is absolutely no liquidity available in the interbank system. So the marginal standing facility, again, which was very high, around 9%, has been gradually reduced to the 4.5%. So, so what we see is that from a scenario of very, very high bank rate, now we're coming to a regime where the rates, all the rates have been uniformly and gradually reduced, be it the bank rate or the repo rate or the reverse repo rate or the CRR or the SLR or the MSF, all have been gradually reduced from the 1990s period to the recent time. Now, the so, and all these things were happening around this LPG duration, that the liberalization, privatization, and globalization. So, now we talk about the interest rate. Now, realizing the fact that these bank rates, the employment of bank rates was not being effective as a tool to control the, the credit, the cost of credit or the availability of credit was not being properly controlled to the employment of bank rate. The RBI started focusing more on the interest rate. Now, so the authority to control the interest rates was under the section 21 and 35A of the Banking Regulation Act. RBI derives this authority of changing the interest rate through these sections of the Banking Regulation Act of 1949. Now, under this particular power, the central bank has the power to control the advances and the deposit rates, both the rate at which the advances will be given or the loans will be given and the deposit rates, both can be controlled. That the commercial banks that are doing, that can be controlled by the RBI. Now, the rates on the loans and advances are controlled mainly to influence the demand of credit and to introduce an element of discipline also in the use of credit. Now, see, when we talk about very high interest rate, now if the interest rate on the loans are very high or the advances are very high, then you will have your users of loan will be less, because the commercial organizations will in that case shy away from taking a loan at a very high rate. So when we increase the interest rates, then the commercial organizations will not avail the loan facility. So you are squeezing the credit at that point of time. But with the moment you reduce the interest rate on the loans, the commercial organizations will find it very easy to avail the debt or the loan from the commercial banks, and so you increase the credit facility and you are expanding the credit towards for the commercial sector. So through this controlling of this loan rate and the rates on the advances, you are able to control the credit flow to the commercial organization. Now, this is generally done by stipulating the minimum rates, that is called the base rate. So, we frequently see that the base rate has been increased by some basis points and like that in the financial press. So, the base rate is the rate that is actually serving as a benchmark for the deposit rates as well as the advance rates. Now, why are we trying to fix a rate on the deposit or to control the interest rate on the loans? Now, the basic purpose behind doing so is to avoid now the unhealthy competition among the banks for deposits. Now, we know that after this this liberalization and this expand the banking norms deregulation, now the commercial banks are able to fix their own deposit rates. They are free to advertise their own PLR, the prime lending rates. So the this kind of a scenario will lead to an unhealthy competition to there will be an unhealthy competition to get the client base. So you increase the deposit rates, so the clients of your competitive bank, your competitor bank will come to you, switch to you. So in the process of attracting more and more clients to your organ or to your system, there might be an unhealthy competition in this, and because of this such kind of an unhealthy competition, the unscrupulous practices, financial practices, unhealthy practices will also creep into the system. So again, this will also endanger the client in the long run. Similarly, when you are free to decide on the loan rate, you will become competitive by charging lesser and lesser amount of loan. And when this in a way can build up an unhealthy kind of a bubble, when it bursts, then the entire banking system will collapse, and ensuring that the end users suffer the most. So to control this kind of unhealthy competition among the banks for the deposit and for the loans and all that, and to align these rates of the interest rates for the loans as well as the deposits, so the RBI employs the base rate to strike an equilibrium between these things, the lending rates of banks and the deposit mobilization rate. Now we talk about the recent trends that we are seeing on the interest rate regime. Now, from a scenario where we saw very high interest rates in the 70s, we could see that the interest rate was very high. In case if you deposited money in a bank, you get very handsome interest in return in terms of interest. And if you go for a loan, the loan rate was as well very high. Coupled with a high interest rate, the growth rate was negligible. I'm talking about a period of 1970s. We usually use a term stagflation to refer to this kind of a scenario: low growth rate coupled with very high interest rate. Now, that is a very unhealthy scenario for the economic well-being of a country. So, in 1991, through the process of LPG, this lot of changes have been brought about, and we see currently a scenario which is low in interest rate but high on growth. So, and we are competing with the best economies in the world through this low interest rate and the high growth model. Now, we'll just have a look at the recent trends that we are observing in the recent scenario. Now, when we talk about the recent trends, I have focused on a few of them. There are so many things available, but I'm only focusing on few of them. Now, the like the interest rate on the domestic term deposit, which with a maturity of 1 month to 1 year, which was linked to the bank rate, and it has been stipulated that the rate cannot be more than 2 percentage points. It cannot exceed, not exceeding the bank rate minus 2 percentage points per annum from April 16, 1997. Now, the non-residential NRE rupee term deposits have been brought under the same control as the domestic term deposits. Now the banks are also allowed to announce a separate PLR, separate prime term lending rate, PTLR, for term loans for 3 years and above. We have also, the banks are allowed to announce maximum spread over the PLR for all advances other than the consumer credit. Now, we have different PLRs for different banks. All commercial banks are free to offer their own PLRs for loans and cash credit components. Now, there has been a persistent trend in interest rate structure, so reflecting the moderation of the inflationary expectations and comfortable liquidity position. So in terms of the interest rate regime, now we are observing a inflationary system which is under control, and liquidity scenario is also under quite comfortable scenario. Now the overall softening, the interest rates have been reduced, has been gradually softened, and from a high of 8% in 2000, it has been eased out to 4.25% in 2021. As we talked about just now, the high interest rate driven economy has come down to a low interest rate, and when we are talking about low interest rate, commercial banks and the commercial organizations find it easy to avail credit, so we are expanding the credit facilities available to the commercial organizations. Now, we have been in the earlier period when we talk about 1990s, we talked about the assured return, very handsome returns on the public sector and the mutual fund division. And from that scenario, we have come to a scenario where this is probably on the pitfalls of this low interest rate regime, is that now we're interesting even the return or the assured income to the retirees, the people who have retired, and they are parting with the retirement benefits. There is no assurance of the return that is given to them. So there is no regime of any assured returns. So this is probably, you can talk about the pitfall of this thing. So the scenario has become such that there is no assured income to these retirees, and it is so we can really appreciate this particular step of the government, that they have established a pension fund trust. The central government has created this pension fund trust to come to the rescue of retirees for keeping their benefits in the trust for an assured reasonable return. So this is a appreciable step by the government of India, and it is the theoretical concept is that there shall be no perceptible degree of difference between the short-term and the long-term interest rate, and it has actually happened that there is not much difference between the short-term and the long-term interest rate. In fact, we observe these days that at times the short-term bank deposits are now yielding more revenue as compared to the long-term investments. So, in fact, banks, that is the reason why you see now banks are not accepting deposits beyond 5 years. So banks are focusing more on the interest rate. So the gap between the short-term and the long-term interest rate has really vanished. So now we talk about we talk much about the monetary policy. Now we talk about the credit policy now. So when we talk about this credit system, there is a general credit control, there is a selective credit control. Now when we generally have a policy for the general credit control and the selective credit control. So when we talk about the money supply is usually available to all sectors of an economy. But if you want that the majority of the money supply should flow to the priority sector, like the government frequently changes its focus on various sectors. Currently, probably the wind energy is a priority sector, the solar energy is a priority sector of the government of the central government. Now at some point of time it was probably thermal electricity, it was probably hydroelectricity. So the focus of the government shifts, and when the focus of the government shifts, we call the focus where the government is focusing right now on the sectors, we call them the priority sectors. Now government would want that there should be easy flow of credit to the priority sectors, and it tries to achieve that. The central bank tries to achieve that through a tool which is called selective credit control. The general credit control assures the cost, the manages the cost of the credit in general and the availability of credit to all sectors. But the selective credit control ensures that the priority sectors get the credit with ease. So this refers to the restrictions on the allocation of bank resources to specific economic sectors. So these selective control measures are distinct. They are quite different from the general credit control measures. And because they target the specific credit uses and the overall volume of credit. So in contrast to the credit control instruments, the selective credit controls are designed to alter the distribution of credit for the purpose of use of credit. For example, if we are focusing more on agriculture, we'll ensure that the agricultural sector field gets more of these credits available to them. So this is basically a high quality of credit control system. And since the middle of 1956, RBI has started has exercising the powers vested in it, and the various commodities have been kept under the selective control regime. So some commodities which were under frequent controls in the past are food grains, cotton, raw jute, oil seeds, vegetables, sugar, cotton, etc. Now this situation has completely changed, and we are now seeing a special favor to MSMEs, to startups, so that we come up with the unicorn companies and all that. The agricultural sector, the allied sectors, we are focusing on that. Now the selective credit control started being were phased out in the 1990s and completely phased out in 1996. And to ensure that there is the inflation is under control and the prices are stable, and to ensure the proper flow of credit to a particular sector, and the credit to other sectors are tightened, selective controls have been effectively used. And the banks have been also given advisory, so that they change if you approach a bank for a particular for a loan and you belong to a priority sector, your margin requirements would be very easy as compared to if you are applying for a loan in a non-priority sector. As we talked just now, there is special favor to the MSMEs and the export-oriented units. It is always there. So as of today, also the MSME and the export-oriented units are also getting priority for this in terms of this margin requirement and easy availability of credit. Now, government is also ensuring that there is easy availability of credit at low cost to the agricultural sector as well as the allied sectors. Now, it is the banks who are playing, rather than the central bank, it is the commercial banks and other financial organizations, institutions, which are playing the major role, the central role in deciding this size and the direction of the flow of credit. And the only limitation is that the priority sectors. Now, because unless you let's say the RBI now is trying to balance between the food credit and the non-food credit. Obviously, the food grains has to be given priority, because if you don't eat, how will you talk about the other commercial activities? So the RBI tries to balance between the food credit and the non-food credit. And it has been seen in the recent time that the flow of credit to the agricultural sector has been quite high, like 12.46.5% of the gross bank credit has been given to the agriculture and the allied sector, 12.5%. And it is growing at a faster rate at 10.4% as compared to the last year. Whereas to the industry, all types of MSME industries, the credit has been of the total gross credit, about 27% has been given to the MSME sector. not only MSME and the large enterprises, whereas the credit to the services such as the transport, software, tourism, etc., is also quite high at 25.5%. The total credits mobilized, 25.5% has been given to the service sector. So we see that there is a equitable distribution of the gross pool of the credit to various sectors, the software, to the service sector, to the industrial sector, as well as to the agriculture and the allied sector. Now, I think we are coming to the end of this discussion of these financial markets. Now, the financial market of any economy, it can be categorized as a organized market or a non-organized or a unorganized market. We talk about the unorganized market in terms of the unorganized market is the market of where we talk about the private money lenders, the chit funds and all. Whereas when we talk about the organized market, financial market, the financial market basically is a market for the finances required for the commercial organizations of the government and commercial organizations. Now, under the organized financial market, we have the credit market. The first one is the credit market. Now, in the credit market, we talk about the leader in the credit market is the commercial banks. So we just saw how the central bank, through the various tools employed through the monetary policy, tries to control the credit availability and the cost of credit to the various organizations, and the commercial banks play a major role in the credit market. Then we talk about the money market, and it is dominated by the call money segment. It is overnight money lending activities, the call money segment. So the market for the very short term credit, that is the money market. Then we have the equity market as well as the term lending market. In terms of equity market, we can talk about the primary market, the secondary market, and for the lending segment, we have the term lending segments. Now, we all know in equity market, you have the primary and the secondary market. Primary is the new issue market, and secondary market is the subsequent market, which is, we also know them by the name of the stock market. So that's basically a capital market. Now, you talk about the corporate debt market. So the loans that the corporate sector is availing, we have the PSUs which are issuing bonds and raising loan from the public. You have PSU bonds. We also have the corporate debentures which are under the corporate, which are dominated by the PSU bonds and the corporate debentures. You have the gilt-edged. The term is typical to the use of the government securities. So you have a gilt-edged market. We call it a gilt-edged market. So the government securities market is called the gilt-edged markets. So it could be short-term. It could also be long-term. Then you have the companies which are advancing the institutions which are advancing the housing finances. These are specialized institutions which talk about the housing finances, which are long-term loans basically. Then you have the hire purchase and the leasing finance markets for the equipments and various commercial activities. So you have NBFCs, the non-banking financial companies, play a major role in the hire purchase market and the leasing market. You hear about the L&D finances and all these kind of companies which are engaged in these hire purchasing activities and the leasing activities. Then we have the insurance, obviously the insurance sector, the life, non-life both, and you have the foreign exchange market to deal with the foreign currency. Now, what have been the, having said, what have been the major reforms that have been undertaken in these financial markets? Now, we have seen that very, very strict criterion has been evolved over a period of time for companies that can access the security market, so that you don't just raise money from the Indian public and vanish the next day, the SEBI has mandated a very, very strict criterion for companies which want to assess the security market to raise finances. The issuers of these securities are required to meet certain disclosure practices, certain standards like payment of dividend, the minimum shareholding requirement, etc. Through this, the SEBI is enforcing that the companies which are assessing the security market are financially healthy. Now, SEBI also took various steps for widening and deepening of these various segments of the market for promoting and SEBI is basically focusing a lot on the investor protection and education. So the development of the market, the widening and the deepening of the market, the investor protection and education, SEBI is working relentlessly in these areas. And the safety and integrity of the security market have also been strengthened through various risk management techniques like VAR, like the derivatives and all that. So they also include the comprehensive system for margining, the intraday trading, the price bands, the circuit breakers, the exposure limits, the various capital adequacy norms. So these are been put up from time to time by SEBI in the capital market. Again, there have been a lot of reforms in the secondary market, which focuses a lot on the transparency and the integrity of the infrastructure. Recently, the FIIs, foreign institutional investors, have also been permitted to invest up to 10% in equity of any company, and in an unlisted company also it has been allowed. The government has also initiated many measures to deepen and broaden the gilt age security or the government security, and try to increase the liquidity. One of the biggest culprits in the government security market is the liquidity. Obviously, when I'm talking about the long-term government securities. So liquidity was a problem. Government has taken several steps to infuse liquidity into that also. The various restrictions that were earlier there on the corporate debt instruments have also been removed. The investment guidelines regarding the utilization of funds of LIC have also been revised, because LIC is the biggest insurance company. It sits over a large pool of funds gathered from the investors. So the various restrictions that was there on the utilization of LIC fund has also been revised. It is also being privatized with a large scale disinvestment through the IPO, and it has to it will have complete autonomy for deployment of fund, obviously subject to the various guidelines of Insurance Regulatory and Development Authority, IRDA. Again, there have been several regulations as far as mutual funds are concerned by SEBI, and these have been revised from time to time. And mutual funds are now playing a very significant role in both the primary and the secondary market with a large asset under management. We normally call it as a AUM, asset under management. With mutual funds are playing a great role, and the recent estimate says that they are sitting on a asset which is close to around 40 lakh crore, which is a big amount. The mutual fund mobilization has been around 40 lakh crore. Now, to talk about the impact on the economic liberalization and the impact on the industry. So, what has been the major impact? The distinction between, as we saw, the distinction between long-term financing and the short-term financing, that has vanished. And banks are now giving equal weightage to the not just the long-term funds but to the short-term financing as well. So because they're generating enough revenue from the short-term loans, so the distinction has really vanished. And we saw in the recent period that the development banks such as the IDBI, ICICI have been converted into ordinary commercial banks, and they're doing really well in the commercial banking sector. So through the deregulation of interest rates and the emergence of a liberalized capital market, and and increasing participation of banks in terms of financing have also significantly influenced the operations of these development banks. Now, since these banks have also come into the sector of working capital loans, the traditional divide between the operational domain of the development banks and the commercial banks have been completely erased. And in fact, we are seeing these development banks are really competing with the nationalist banks in terms of these working capital loans. The monetary policies have ensured the provision of these changes that we are talking about right now. They have ensured that the enough liquidity is there to meet the credit requirement, the growth in the credit requirement of the commercial organizations, and the investment demand, the requirement of the investment of the corporate sector in the economy. But at the same time, they have kept a vigil on the movement of the price level, on the monetary aspect, on the various shortcomings on the loopholes on the monetary system. They have also kept an eye on that. So on the external front also, the government of India has is competing now with other systems, with correcting the other economies through correction of the exchange rate valuation, and liberalization on the external front is that the foreign investments are now thrown wide open, and the foreign trade as well as the foreign investment, which are mutually influential, the portfolio investments are also coming to India in a great force. The FDI has also, India has become a favorite destination for the FDI. So in essence, what we are seeing that these changes that we talked about in the monetary policy and the credit policy, they have produced some direct and some indirect effects on the growth and development of the Indian industry. And these developments are really of permanent nature and which are going to reap benefits in the years to come. Now, this development of course, the person in charge of this working capital management has to be aware about these particular developments, because he has to use these environmental factors for effective use of this working capital management. Now, now that we have come to the end of how the monetary policy and credit policy and the financial sector has evolved over a period of since the 1991, we can understand that when we talk about the working capital management, we're talking about the short-term credit availability, what kind of an important role that plays, the monetary policy and the credit policy that play on the working capital management sector. So anybody who is engaged with this working capital management has to be very, very aware about this kind of developments happening in the scenario. So that you can quickly assess the credit facilities available in the commercial banks in a short-term basis. So to sum up, we saw that the monetary policies through these various rates, interest rates, SLRs, there are various key rates and the various selective credit control regime, and all these things they have kept a balance between the inflation as well as the liquidity in the market, and what kind of a role they can play on the working capital financing of the firms, and how these insights can be used by the working capital manager to effectively play between these factors and achieve productivity and growth for his organization. So we'll see more about the determination of working capital in the next class. For this class, we stop here. Thank you.